Welcome to FX Tech's comprehensive GBP USD analysis for November 10th through 15th, 2025. This week marked a critical juncture for sterling as it consolidated near a major technical trendline while markets priced in an 80% probability of a December Bank of England rate cut. In this presentation, we'll examine the narrow BOE vote split, analyze Federal Reserve policy uncertainty, break down critical technical levels, and provide actionable trading strategies for different market participants. We'll also explore short-term and medium-term scenarios with probability-weighted outlooks. Whether you're a trend trader, range trader, or swing trader, this analysis will equip you with the insights you need to navigate the current market environment. Let's dive into the data. Sterling traded in a remarkably narrow range during this period, oscillating between 1.3108 and 1.3201. The pair closed at 1.31724 on November 14th, down 0.14% or 18.4 pips on the day. While the 5-day performance showed a modest gain of 0.13%, the 1-month picture reveals weakness with a 1.70% decline. Year-to-date, GBP USD remains positive at plus 5.28%. Technical indicators present a neutral picture, with oscillators and moving averages showing mixed signals. However, the critical break below the 55-week exponential moving average at 1.3185 signals potential trouble ahead. Key market drivers include the Bank of England's narrow 5-4 vote to hold rates, disappointing UK employment data, and the surge in December rate cut probability to 80%. The consolidation near the major trendline at 1.32 represents a pivotal moment for the pair. The November 7th Bank of England decision revealed significant internal division with a narrow 5-4 vote to hold the bank rate at 4.00%. Notably, BOE's Breeden joined the dovish camp, voting for a 25 basis point cut. This dissent, combined with Governor Bailey's comments that a December cut is conditional on inflation confirmation, sent a dovish signal to markets. UK economic data deteriorated across the board, with the employment report missing expectations on all metrics. Unemployment is rising and wage growth is slowing. Before the next BOE meeting, markets will scrutinize 1 employment report and 2 inflation releases. The UK autumn budget on November 26th adds another layer of uncertainty, though Chancellor Reeves has stated no tax increases are planned. The 80% December cut probability reflects market conviction that policy easing is imminent. Federal Reserve policy remains in flux, with December rate cut odds standing at 50-50. Interestingly, the US dollar showed negative weekly performance despite decreasing cut probabilities, driven by profit-taking, position adjustments, and China-related concerns. The key data releases are September and November non-farm payrolls, with the November report serving as the final say before the December FOMC meeting. US-China trade tensions continue, with China investment declining over 10% and consumption slowing, providing selective safe haven support for the dollar. The policy divergence scenarios are critical. If the BOE cuts while the Fed holds, GBP weakness is likely. If both cut at a similar pace, range-bound trading could prevail. If the Fed cuts more aggressively, GBP could strengthen. This divergence will be the primary driver of medium-term direction. The technical picture shows critical resistance at 1.3247, which represents former support turned resistance, and the major trend line at 1.3200. On the support side, 1.3100 has provided strong support with multiple rejections, while the recent low at 1.3008 represents a critical level. Below that, the 138.2% projection target at 1.2831 and the April 2025 momentum zone at 1.2750 are key downside objectives. The break below the 55-week EMA at 1.3185 is particularly significant, as it marks the first sign that the corrective rise from the 2022 lows at 1.0351 may have completed. This opens the door to deeper declines. A decisive break of trendline support at 1.2824 would target the 38.2% retracement at 1.2474. Pattern analysis shows daily chart rejection at 1.32 with a pullback underway. 4-hour chart multiple rejections at 1.31 support, and 1-hour chart choppy, directionless action. Our analysis integrates insights from 5 leading sources. TradingView shows neutral signals with key resistance at 1.3201 and support at 1.3108, recommending traders await a breakout. Investing Live adopts a neutral bearish stance, suggesting selling the trendline and buying support. Action Forex takes the most bearish view, recommending selling rallies with a target of 1.2831 as long as 1.3247 resistance holds. Forex.com is neutral bullish, noting that holding at support would be constructive. Daily Forex's Christopher Lewis is bearish, viewing each rally as a selling opportunity with a target of 1.2750. The consensus is predominantly bearish, with 3 of 5 sources recommending selling rallies. A break above the 200-day EMA would be required for bullish consideration. Critical support at 1.3000-1.3008 represents the line in the sand for bears. For the next 1 to 2 weeks, we assign a 60% probability to the bearish scenario. This would be triggered by failure to reclaim the 1.32 level, leading to a gradual decline toward 1.3008 and then 1.2831. The recommended strategy is selling rallies between 1.3150 and 1.3200, with stops above 1.3250 and targets at 1.300 to 1.2831, offering a risk-reward ratio of 1 to 2 to 1 to 3. The neutral consolidation scenario carries a 25% probability, with the pair trading between 1.3100 and 1.3200, while awaiting UK employment, inflation, and US NFP data. The bullish scenario has just a 15% probability, requiring a break above 1.3247, catalyzed by weak US data or a hawkish BOE surprise. Key events to watch include UK employment and inflation reports, US September and November NFP, and the UK autumn budget on November 26th. Most likely trading range, 1.2950 to 1.3250. Looking 1 to 3 months ahead, we see 3 scenarios. The continued decline scenario carries a 45% probability, driven by BOE cuts in December with signals of more to come, while the Fed holds or cuts slower. This would target 1.2750 to 1.2831, with a potential extended move to 1.2474. The range-bound scenario has a 35% probability, occurring if both the BOE and Fed cut at a similar pace, keeping rate differentials stable. This would establish a range between 1.2800 and 1.3400. The recovery rally scenario has a 20% probability, requiring the BOE to hold due to sticky inflation, while the Fed cuts more aggressively. This could target 1.3400 to 1.3450 initially, with extended targets at 1.3600 to 1.3700. Critical factors include monetary policy divergence, UK economic resilience, US economic trajectory, global risk sentiment, Brexit developments, and central bank forward guidance. Most likely 3-month range, 1.2650 to 1.3450. For trend traders with a bearish bias, the approach is selling rallies toward resistance zones between 1.3150 and 1.3250, with stops above 1.3280 and targets at 1.3000 and 1.2831, offering risk-reward of 1 to 2 to 1 to 3. The rationale is that technical and fundamental backdrops favor bears. Range traders should buy support at 1.3000 to 1.3050 and sell resistance at 1.3180 to 1.3230, with tight stops, targeting the opposite end of the range for 1 to 2 risk-reward. Swing traders should exercise patience, waiting for confirmed breakouts. A bearish entry below 1.3000 targets 1.2831 to 1.2850, with stops above 1.3080. A bullish entry above 1.3250 targets 1.3400 to 1.3450, with stops below 1.3180. Risk management is critical. Position size at 1 to 2% per trade. Always use stop losses. Monitor correlation risk. Reduce size before major events, and use leverage carefully in volatile conditions. Upside risks for GBP include a hawkish BOE surprise with a December hold, a dovish Fed pivot with more aggressive cuts, positive UK data beats, broad USD weakness, and improved global risk sentiment. Downside risks include aggressive BOE easing with December cut and dovish guidance, continued weak UK data, a hawkish Fed with December hold, Brexit headwinds, global risk-off flows, and technical breakdown below 1.3000. Our current assessment. GBP USD is at a critical juncture near a major trendline. The fundamental backdrop is bearish with BOE easing and weak UK data. The technical backdrop is bearish with the 55-week EMA break and resistance holding. Short-term bias favors 60% probability of further downside. Our recommended approach. Exercise caution, employ strict risk management, favor selling rallies over buying dips, wait for clear directional signals, and monitor UK and US data closely. The break of the 55-week EMA suggests the path of least resistance is lower. Trade with discipline and remain adaptable.